Teach me how to grow a real estate investment portfolio. That's exactly what I'm going to do in this week's episode of Prime Property. Promise you, it'll be worth it. So make sure you stay tuned. Good day, Toronto. Welcome to another episode of Prime Property TV. So glad you joined me here on this episode of the new Teach Me series. I'm going to show you exactly like I did last week about how to grow a portfolio. So if you missed last week on how I taught everyone how to get a free property utilizing their existing property, you don't want to miss that. Right here, it'll be on this top right corner right there. So you can go check that out. So it's going to be, I want to say requirement or prerequisite, but it'll be good if you watch that video because I'm actually taking the exact same property that I analyzed in that episode on how to get the free property and apply it to this one on how to grow the portfolio. So there's a little bit of continuity, you know, it's like the real estate investing of the MCU, right? So on this episode, I am going to show you how to grow the portfolio from one property to another because a lot of times people always want to know, you know, how to get from A to B and B to C and C to D because, you know, they plan a lot, you know, especially engineers and accountants, right? So I know this from first-hand experience. So I'm going to give you a little bit of insight on how a lot of my clients grow the portfolio. And I always say you go from 1 to 2, 2 to 4, 4 to 8, 8 to 16, assuming you do all the right things. And obviously there are little nuances in between here and there for like qualifications, corporations, taxes, and all that stuff. But that stuff gets really complicated. So I'm going to dumb it all down and kind of just simplify on how to get property number 2. And, you know, obviously everybody has a different situation and everyone's going to have a different scenario on why and how they can and cannot do things. And that's why you kind of require a more personal approach on how to actually invest in real estate. So again, this is great. Very graciously, my client let me use their property as an example on how we grow and, you know, thank them. Otherwise, you know, I can't share this stuff. So thanks to my clients for allowing me to do this. But again, if you want to know how this applies to you personally, you can book a call with me using the link right here. It's www.chatzen.com because we do this all the time and showcase this because there's no secrets to hide because I want to help everyone understand and debunk any myths about real estate investing because you know what? Sometimes people who does hit the fan, it's not going to be easy. It's not a get rich quick thing, but it works and it works very fast. You can create a lot of intergenerational wealth that can pass on to your kids, maybe yourself, retirement money, maybe to leave your corporate job. There are a lot of reasons why people originally, but you can do that with real estate investing. And that's exactly why I want to show this out to you. Yes, I know there's other realtors who are going to copy me, but if you want to know exactly how I do it, because there's a lot more than just what I'm showing you right now, again, book a call with me using the link right here on the screen. It's www.chatzen.com. So without further ado, let me show you how this numbers work for growing a portfolio. With the magic of video editing, I am going to become small now. Right, so if you missed last week's episode, this is the property that I have used. It's 274 Harmony. You can see right here, the numbers already plugged in on the left-hand side. And what I'm going to show you is how we're going to grow that portfolio, okay? So in this property, we bought this in December 2020, right? So most of the time you'd be refinancing your property like, you know, every 3 to 5 years. And that's why I'm saying it's very hard to lose money in real estate in 3 to 5 years because it's kind of like a hockey J curve. It goes up, right? You know, sometimes it kind of chills, and then like whoop, because as it goes up, the appreciation goes up and you get 100% of it while you pay 20%. And at the same time, your mortgage goes down, right? So it's kind of like a giant J curve that swings up. Now, obviously, when we bought this property, these clients of mine listened to me and we bought some stuff before the market went crazy because we saw the trends happening. And again, this is the reason why you want to be on top of the market. So right now, if I were to sell this property for them, it's probably in like the high 8s, okay? But do not expect a $100,000 appreciation in your property in less than 1 year. That is not normal because we saw a 25% increase in price in the last year, starting from like June, give or take right now. So again, not normal. Normally it's like 6 to like 10%, right? 6% because it's the last 40 years average and 10% in the last 5 years average, not counting like 2020 because I was like, you know, like gangbusters, okay? So you want to be conservative with this. But again, I'm just showing you what we can do right now because there was a little bit of luck and in our preparation and getting the property out there, right? So I'm going to show you a property which is literally down the street that just sold a little while ago. So this is 274 Harmony. This is now 224 Harmony. You can see the style of house is very, very similar. It's a detached bungalow, right? This one has a little bit more parking spot, but it doesn't have the carport garage. The backyard's a little bit smaller. Inside's a little bit nicer than what we got it for, but obviously we put a little bit of money in it, like very, very little. Right, and this one, I'm going to show you something which may blow your mind, but this one was 21 offers on offer night. This was, let's see, June 29. So this is a little bit more than a month ago. So it is crazy, okay? because again, I'm slowly letting the secret out on what we're doing. A lot of people are copying us. And you can see here that very nice property. It probably rented out very well. This is the one that we didn't buy. And there's also 2 bedrooms downstairs, I believe. And this one's done quite well, really large bedroom. So I think this one's a little bit nicer downstairs than the one my client bought. But again, I'm just using it as an example, right, to kind of do a comparative analysis for you. So, that's kind of the property. Very nice. So sold for $900,000. So how do you grow your portfolio? The first thing, and in case you missed my variable mortgage or why you should get a variable mortgage, I think it's titled fixed or variable mortgage, watch it up here, right? So you understand why we get a variable mortgage. So what we're going to do right now is we're going to go and break this mortgage to get money back out there. So let me pause the video. I'll enter some numbers for you. 1 second. Okay, so we're back. So you can see here on my left-hand side, what I basically did was this was the previous property that we bought with the numbers, and I put in a new market value of the current market right now in September 2020 based on the fact that 224 Harmony Road North just sold for this amount. Now I'm going to be conservative and say that if we were to go get an appraisal on our existing property right now, it would be $875,000, a little bit less than this one. Okay, again, I just like being conservative. So how you calculate these numbers is you're going to basically refinance, break that mortgage, right? And again, go variable for this reason, and you're going to get a new mortgage at $875,000, which is $700,000. And how this all works is you have to take the $7,000 new mortgage you get, you have to pay off the old one, which is $6,000, and then anything that's left out is what we'll call a cash out refi. So you're going to get this $100,000, right? 700 minus 600 into your checking account, tax free, while the tenants are still paying for this property, right? So let's look at the numbers. If you get a new mortgage at $875,000, right? $700,000 mortgage, again, to 2% rate. Again, I'm just keeping the numbers that you borrowed from the property. Technically, this number should be this number, right? So I'll just do that for the purpose of illustration, right? So, you're still paying $500. Why is it doing that? 1 second. There you go. So you're still paying $562 extra every single month at your primary residence from my previous video, right? Numbers all stay the same, rents are still the same, everything. You have no legal costs, maybe like $1,500 in legal for the refi, or maybe even less, right? But again, I'll show you why I don't include it later. And you're still plus $550 a month. So this thing, even though you've taken money out of your property, is still paying you $530 a month. This is gas money, grocery money. It's still money you can spend. And the tenants are still paying for it. This is the beauty of knowing what to get for real estate and how to invest, right? So when you have your tenants still paying, you reduce your cash flow, but you've taken $100,000 out of your property tax free. And this is my favorite reason why I invest in real estate, because it's a financial instrument. I hate using that term, but technically is, and you can refinance it and borrow from it, right? So when you borrow from it and you have $100,000, what are you going to do, Baz? You can buy another one of these properties. Maybe you don't have enough down payment. You would have had a line of credit on this and you can refinance or borrow from it, and you can top it up for like another $175,000 to buy another one of these properties, right? Or you can go buy a condo downtown. If you don't care too much about cash flow, you can take a little bit of negative so you can hedge against, maybe prices going back up in the future, right? So you have options. And keep in mind, this only happened in less than 1 year. I'm not saying you should anticipate it, but it's there. Now, this $100,000 is a very, very overarching amount because you are going to have to break the mortgage, which will cost you 3 months interest. But the reason I didn't put it in here is because every single month that we've had this property, which is 9 or 10 months right now, we've paid down the mortgage, which is $2,000 a month, and like 60% of that goes to paying down the principal. So the amount of mortgage you're actually paying off from the refinance is actually less, which is actually probably higher than the cost to break it and legal fees, but I'm just not going to put it in there for this illustrative purposes. So you're doing a $100,000 cash out, and then you put that into another property. So let's just say, for example, you're going to go buy, a condo downtown for $500,000. Well, let's just say a bachelor's downtown for this much money. You have taxes for this much. You have condo fees of this much, right? You're probably going to get rents of right now $1,900. You're going to have the condo fees. Your insurance on that is $50, and you have no hot water tank rental. So you move this money into here. You need 108. You have to somehow fish out the other, call it $8,000 for closing in a Toronto condo. Now you're minus $62 a month, right? But when you take your sum of both of these, right, you're still positive $467. And now you have two properties that have come up from you investing from this from a year ago, right? This is the power of real estate and growing a portfolio. The idea, what I always tell my clients is, while you're young, you want to lever up smartly, self-liquidating leverage, meaning your tenants pay for you. Because I tell this to a lot of people. You have to remember, when you use other people's money, meaning the bank's money, and your tenants are also paying for it, you're also using their money, you're getting the benefit of all the assets appreciating because they're doing real estate investing the right way, and that's how you win. So at the end of this, if say my client were to buy something, with their refinance, right, you are still owning now 2 additional properties for free, because remember, we started the first one off for free, and now we got a second condo, which is still paying them $467 a month in cash flow. And on top of that, every single year they're going to get $17,000 in mortgage pay down plus $10,000, or let's call it $9,300, that's what the number says, from the mortgage. So you're all in every single year a minimum $26,000 increase in equity before any appreciation. Just think about that. This is how you grow your real estate portfolio, and you rinse and repeat, rinse and repeat. So I call these like the refinance cycles. Depending on when you buy a property and what your ability to qualify for, you can always keep growing this if there's equity in there, right? So you can also layer this with different strategies on top, and this is where things get kind of crazy, and there's a lot more strategies out there if you really wanted to, and that's kind of where I get really nerdy. But this is kind of like step 2 of our like 5-6 step process and helping our clients grow their portfolio. Because you have to keep in mind, if you hold these properties for 25 years, right? Or 30 years, whatever, right? Even before any appreciation, you have a free property that spits out rent. So if you have no mortgage, you're basically getting like $4,000 a month in 30 years. That'll more than be your pension before any pay down and appreciation, right? Same with the condo. And the beauty and why in real estate, and why a lot of people kind of like BlackRock is coming in, it's because this intrinsically has a hedge against inflation, because rents can increase and so can your asset price. Whereas right now, the stock market and the bond markets are being suppressed, and that's why a lot of people are flocking into real estate, and that's why the asset prices keep going up. I'm not saying we're going to see price increase like what we did in the last little bit, but where we're going to see 6 to 10% increase per year for the next, like, call it 4 or 5 years? I would not be surprised. And I'm not saying this to give you FOMO. I'm just saying, even if the prices don't go up, as long as you have cash flow and mortgage pay down, you're still investing in the right way, because those are things you can control. Appreciation is what you can't control. But if it comes along and it speeds up our ability to grow the portfolio faster, wonderful. It speeds it up. But if it doesn't, it's cool. You can still do it every 3-5 years in every single refinance cycle. So this is why I say you go from 1 to 2, 2 to 4, 4 to 8, 8 to 16, and at some point you may want to stop, right? But if you're addicted and you get bitten by the bug, just continue. It's cool. We do it that way too, right? So hopefully this gives you an idea of what we do and how we grow our real estate portfolio. Guys, give me a little bit of comment and feedback. If you like these type of videos, I can continue making them if you want. And for anyone who's out there trying to basically get an idea of how they can get started with getting a free property and then growing their portfolio based on their financial situation, you can book a call with me using the link on the screen. It'll be www.chavzan.com. And until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.